Roundtable on the Odyssey pod. This is by far the largest roundtable we've ever had. We are joined by a few very special guests. So we have Rob from InfiniFi, we have Mara and Steven from the DeFi Dojo, and we have Vlad, the founder of Tau Labs. So a bunch of people on the pod who are either like somewhat involved or observing the entire shenanigans going on in the Vault ecosystem right now. So yeah, how's everybody doing? What a week, guys.
It's rough.
What a year this week has been.
Yeah. There we go. That's a good way of putting it.
Pretty good. It has been a wild ride, I'll say that much.
How have you all weathered the storm? Like, what's the initial reaction? Is there a lot of firefighting, or would you consider yourselves and your portfolios pretty safe?
I'd say Balancer was less harmful to most people that I know than the stream contagion. And then I think we're still sort of waiting on bated breath to see how bad the spread is there with regards to curation. So cool we have a curator in here. But a lot of the markets, I mean, my personal funds, I thought I was being kind of cute lending on Plasma. And those funds are probably going to be stuck there for the next like 4 or 5 years. So we'll see. But that was my big L of the week.
Sorry to hear that, man. Personally, I avoided exposure entirely. I thought Caleb seemed like a decent dude. I obviously, things are shaking out in a way I don't think any of us really expected. I took no exposure because the strategy was just too rehypothecated for my tastes. So personally, I have no exposure to it. InfiniFi had no exposure either. We disqualified it during the risk process when we realized just how levered up the whole thing was. I'm very glad we did.
Yeah, I had roughly 10% of my portfolio in it, so I'd consider it down to zero, just preemptively, because I mean, it's with the TLDR on the situation is there has been a 93 million hole in stream, and allegedly by an external fund manager, but the announcements are all pretty legal speak, so it is not confirmed who that legal fund manager was or who the entity behind that was, if these 93 million are gone for good, if there is some option of partial recovery, if it's just stuck in a bankruptcy proceeding of a TradFi fund, or if it's another DeFi fund. So there is a lot of uncertainties. 0x Law, the founder of Stream, and just as a disclaimer, we've also had him on the pod, and like I'm personally invested in Stream, so I have a big financial incentive for this to get resolved. And he said that his personal strategies were not the ones that lost money. Obviously, it's kind of a bunch of different claims out there. CBBOE, who started raising a lot of concerns about Stream and similar protocols around a week ago. He's still more on the side that there have been shady things going on 0x Law's side, and it's very unclear what the actual status is. I think we can just hope that the truth will come to light rather sooner than later, and in the meantime that nobody's getting hurt or is hurting himself, because there have been some rumors about that as well. But maybe let's start to unpack the entire situation, how it came to be. So from your guys' impression, was there something that happened on October 10th that led to this entire collapse happening? And do you think that the initial concerns raised by CBBOE and others about stream finance and the recursive looping of mostly Elixir, the DEUSD, if I remember correctly, is that directly related to the collapse happening now, or how did it all unfold? And how did you guys weather the storm?
I don't think anyone knows anything, right? I mean, it's all purely speculative. For example, we've heard so many different things. Like they had a big allocation into like Stable, which was like a pre-deposit campaign. But I haven't seen. I've been like sleuthing around on chain, and I haven't seen a single wallet that has any indication of that. There was also supposed to be like big basis trading that was happening on later. There were some big wallets. I think he shared wallets publicly that have hundreds of millions of dollars on them. but like unclear if that's partial ownership, full ownership. So I think that like it's pretty hard to speculate like with just a patchwork of information of things that 0xLaw shared that may or may not be true. I think it's at this point like really, really hard to know, take anything he said at face value. But yeah, I mean, it seems quite likely that this was related to 1010. I think we all kind of expected to see, people getting hit heavily. I mean, it was the largest day of liquidations that's ever happened. And, the market has been very erratic since then, very liquid since then, but we hadn't seen anyone kind of roll over and say, I got wiped out for hundreds of millions of dollars, and this was a day when there was tens of billions that were liquidated. So, I think it's an easy thing to point to, but I don't think there is any, real data, real information that we have. I don't know if we're going to start getting this in like legal proceedings and stuff like that. Maybe that's how this will all play out. Maybe there'll be someone will come and just kind of like post a lot more information. We'll get information that way, but I don't know. I think that it's purely speculative unless Caleb or someone from that team like is explicit in like what happened and where the losses were.
So I would agree with you that it is truly pure speculation as to what happened to losses. I mean, it's not hard to guess what would have happened here to a delta neutral hedge with the big wick we saw on 1010. What that would have done to someone who was, both long and short, if they were doing this on purpose, is the first wick would have wiped out your longs, because anyone who was over 1.5x leverage got wiped out. It would have put your shorts in the money. And if you had been able to rebalance on that wick, you would have still been delta neutral. The problem with 1010 was that it was a V-shaped recovery. And anyone whose systems did not automatically do that, and who was relying on their own trading acumen to be able to do that, and even people whose systems did try to automatically do that in some cases, they weren't able to. And anyone who didn't do it automatically, they by the time they realized what had happened, it had already gone and their shorts were no longer in the money. Their longs were wiped out and they were just negative. So the mechanism by which this happened, assuming that's what happened, is pretty clear, I would say. Like, I'll give this is just speculation, though. I do think the leverage that they had, which you call leverage, and I am making the strong case that is not just leverage. I think that what they were doing there with these borrows on XUSD, they say it was, this is just us looping our own capital. I don't think that's what it was. I think that there is no difference between them effectively looping their own capital in that and something that would be really thought of as just a true uncollateralized loan. Because at the end of the day, all you're doing is you are printing an ERC20 token that you command and control the minting and redemption of. You're printing it out of thin air. And whether that minting is then recursive with deposits and there's actual USDC flows, the outcome is the same. You mint 70, 80 million of XUSD out of thin air, borrow 70, 80 million of USDC and take it off chain. That's just an uncollateralized loan. There's nothing that's backing that loan anymore because the money's in your wallet. It's gone. You could literally fly off to Bali if you felt so, called. The guardrails are gone. It's uncollateralized lending. It's not looping. It's uncollateralized. And those poor bastards on Euler were getting so much worse terms than anything on Wildcat. Wildcat is like 14% APR, 20% APR, legal agreements in place, recourse, proper channels to, get your money back. This is so much worse than that. This is so much more dangerous. And that's why, when it blew up, I don't think people, the hole they've admitted to is 93 million. I think the hole is probably closer to 400.
Yeah, I mean, that's where it's getting interesting because, as you just mentioned, that there were people lending to Stream on Euler and through other vaults. And if it was just Stream being hit, I think an isolated 93 million or however high the lost sum would be incident is not that detrimental to DeFi in the grand scheme of things. I mean, with Terra Luna and UST, we've seen a 20 billion collapse within a few hours 3 years ago. But the issue here is that there is a bunch of contagion risk, and it is like at this moment unfolding which other vaults, which other vault providers, which lending protocols were partly or directly affected by this. And this is probably going to create a very bad look on the industry and some of the actors who did not take their risk management seriously. So maybe if one of you want to explain how these contagion and these like very intertwined relations between different vaults, lending to stream, came to be, I think that would be great for the audience.
Steven, you want to take it? You have that very professorial way of explaining things.
Not how it came to. I mean, how it came to be is probably they just reached out to a team and then said, "Hey, can you bring us TVL? We'll bring you TVL." And then it got a little bit out of hand. Where, okay, now can you borrow against this? And then we'll mint more tokens. And then we'll leverage that up. So the way it came to be is just a bunch of relationships with borrowing, lending, and then the curator is kind of stuck in the middle, where curators are the means through which these markets get spun up. Now, curators are supposed to do one very specific thing, which is risk mitigate and do like the due diligence for do the diligence for lenders and set like LTVs and LLTVs. Sometimes the LLTVs are set by the protocol, but at least set LTVs and caps, and so they're supposed to be the risk curator of the market. And so we actually have a curator in here, which is kind of cool. I'd love to hear his take on this. Yeah, I mean, you know what? I'll let you explain your perspective on this.
Sure. First of all, a little parenthesis because I didn't mention at start. Tau was not directly affected by stream at all. We saw and we still see pain in our loops because borrow rates spiked across the board. Utilization hit 100. We see that they are normalizing now. So if you're in any of our loops, we just made a post 30 minutes ago. All of the profits from the last 14, 15 days were wiped out on both our InfiniFi and Res loop. That is the worst that Tau was affected with. The lending optimizers are doing great. The bond ETF is still solid. So all of our other strats are doing well. Shame for the loops, but it is a risk, unfortunately. Steven, on what you said,
I 2 weeks worth of my yield.
Yes, that I also generated for you, Rob.
No, I know. I'm in the vaults myself.
Can you guys maybe explain how it came to be that the yield of the InfiniFi vault got eaten up through the last few days? Like, how did the stream contagion and like its implosion and everybody wanting to panic exit out of certain vaults, how precisely does that translate into other strategies which are completely unrelated to that, suffering losses in their yields?
Sure. The mechanism is very straightforward. Stream blew up, and a lot of the curators, we also like talk to each other a bit, and you talk to the market. You kind of start seeing in Telegram groups and next to something is wrong, and at that point, it's basically game theory, and people are trying to pull out. The problem is you have Ray from our team, 0x Roger. He did a great explanation at one point, saying whenever you want to get out of a very pre-hypothecated market. Let's say you have like a $50 million football and you want to exit through a $3 million hole, and it's the same equivalent. Too much money was trying to delever and exit all at once, and there's only so much supply on the lend side. This caused utilization to spike and markets to be locked. And this then goes through all of the vaults on Morpho that allocate to other markets, on Euler, same. And all of this just goes on through literally every yield-bearing stable in every market. It didn't affect wrap Bitcoin collateral too much or like other ETH assets too much. They still stayed at like 4-point-something%, which is kind of their average. But stable coins were hurt. And one thing here, this could also be an opportunity. If the underlying stablecoin projects, so whether it's InfiniFi or Resolve or whatever else, you getting locked in a market when utilization is 100 means there's no liquidity to exit. If you do get locked in that, you are farming spot for like 30-40% plus. So there is a way to take advantage of this. However, you take on the risk. Now, that market would only blow up if the underlying project blows up, which for all of these projects is highly unlikely. If, however, you are in the lend market for stream, I'm pretty sure there's not farming spot for 50% in this market isn't really worth it at that point. But the mechanism through which the contagion happens, is, at least on the lend side, is very straightforward.
What would you say was the underlying metric or incentive very many curators were optimizing for that led to this entire mismanagement of risk structure?
I
Is it just like, is it the advertised APR? Is it just chasing TVL?
do have a take here, and I do want to say it. I'm sorry, the other guys. When we started, so we launched our first vault in April, right? And we had a long conversation inside Tau of how we advertise, because we were seeing Midas starting to get popular, and we were seeing a lot of people. We weren't looking specifically at stream. A lot of other curators basically double counting their TVL, rehypothecating it, then tokenizing it, then lending against that tokenized rehypothecation, etc. And that's how we saw that they made a lot of high yield. High TVL. And the thesis initially was, if we do that, we will maybe blow up at one point. So should we just announce deposits? And initially, I went to some conferences in May, and my discussions with funds and LPs were just our deposits. I was advertising 2 million or whatever, which we haven't had in deposits back then. Rehypothecated up to 20 million in what can be called TVL. Nobody cared. The traditional funds didn't care. The LPs, whether they are institutional, serious, and mature, didn't care. Degens didn't care. However, the second I started talking more about our TVL, everybody started to listen. The more that number grew, I started to be invited into groups. I started to be inviting into meetings at conferences with bigger LPs, with bigger funds. The incentive structure is all broken, because you can rehypothecate your TVL, you can inflate it like crazy, and you can simulate a $10 million deposit into a $250 million fund, and that's who you're fighting against. If you don't do that, you fall behind other competitors who do. If you do that, you take a reputational risk. So this is an incentive structure that is all wrong in the space, in DeFi, on fund side, on protocol side, on everybody. And I'm curious to hear your guys' take on that. That's why I jumped on this automatically, because we've been discussing it for months inside Tal on how do we market, how do we advertise.
Well, we're gonna see how much people put on the line with their reputation, because now we have a few curators who are scrambling. I don't know if you guys have been checking the chains, but I was looking at Plume and Avalanche earlier, and people are just sucking their liquidity out of these markets, specifically from the curators who have been exposed to this extreme kind of contagion. And yeah, I don't know if you're pulling something up, but yeah, there are some names named there. I wasn't gonna throw under the bus because I know a few of these guys, but yeah, like if you look at the rates right now, lending rates to things that are seemingly completely unrelated. So like Plume has none of these assets, right? There's no relationship at all to any of the assets that are affected. However, zero liquidity. It's all been withdrawn from there. Rates are like at 33, 34%. And I think it's because there's just this assumption that these curators are in some way on the hook for some of this presumably upcoming bad debt. So we shall see what the shakeout does.
Yeah, maybe can one of you explain, maybe Mara, if you looked into it, how did this entire thing translate into a bunch of TVL exiting from lending protocols like Morpho and Euler, and what do you think are going to be the downstream implications for the vault curator and also infra landscape? And do you think that there were any blatant mistakes being made by parties other than Stream Finance, or is it just kind of everybody's a victim of these circumstances now?
Yeah, I mean, as this list here shows, I think that it might actually be slightly higher, because there's also, so this list that you have here from Yams, which I think is excellent, has $285 million of liquidity that essentially was lent out against Stream assets, both XUSD, XBitcoin, and XETH. And this money, is going to be locked, unfortunately, in, I think, what's going to be probably quite a convoluted, legal battle. You have all sorts of different parties who I think have interest in this. You have Silo, who said that they're going to get involved in a legal battle. Mev, who said they're going to get involved in a legal battle. Like Elixir, who said they're going to get involved in a legal battle. These are just people that have said it publicly. I would assume everyone ends up participating in this. But these funds, were lent against Stream assets, and then those assets, to a large degree, were borrowed either by the team over at Stream or by the Stream protocol itself, and then recursively looped up. The recovery for this, I think, is going to be a bit tenuous. There's even more actually though, because there's a lot of assets that are lent against Elixir as well, especially things that Stream themselves borrowed against Elixir assets. So from what I've seen, I think the true number might be closer to $400 million. And so you have essentially $400 million in Euler and Morpho and Silo that, was available, was looking for yield, thought it was kind of like, at least somewhat safely sitting in curated vaults, curated positions that, I think is going to take at a very minimum a big haircut and probably in the best case scenario be locked for an extended period of time. And I think that makes folks reevaluate the whole curation money market space as a whole. And so what we've seen is this money is just stuck. It's just kind of like frozen in time now. But all the other money that's kind of like lent out to other vault tokens, other stable coins, all sorts of stuff, is de-risking, right? People are like, well, I'm only getting paid 10%. It's not worthwhile me hanging in here. Maybe I just pull everything out today and come back in a week and see how the dust is kind of settled. There might be, concerns of socialized losses. I don't think that's probably like a real risk. I think that like the actual risk is mainly just in the Stream and the Elixir pools themselves. And it isn't something that has like broad contagion in the traditional sense where we're going to see dominoes fall one by one by one that had exposure to Stream. I think it's more like people are just panicking, pulling funds, which means that like a lot of people are stuck in these loops, right? So there's a lot of money where the utilization's gone to 100% or in the high 90s. The interest rate then spikes, and then it's basically up to the person who's holding the collateral, who's borrowing the assets, to unwind their position. That takes time. A lot of these new vault protocols have delays, so it might be an hour, it might be a couple of days, maybe even a couple of weeks in some cases that it takes to get out of these positions. And so I think that's what we're seeing now. It's not contagion in the traditional sense across, it's just a lack of trust that's going on. And in terms of like blame, I think I'm not someone who likes to assign blame too early. I'm sure there will be lots of, crypto Twitter threads assigning blame to all sorts of different people. I do think that this shows big holes in the way, money markets and curation works. I think that's pretty clear. I think that like, the industry needs to take a pretty hard look at like, how oracles work. We went all the way from just having truly market rate oracles that were causing a lot of liquidations and risk on the collateral side to then, these fundamental oracles, which pushed basically all the risk onto the lender side. And we need to find something that's in the middle. I think that both of the solutions have issues and we need to find something that's, more in the middle. And then on the other side, I think curators, need to look at themselves and like look at what they're kind of enabling in terms of having large amounts of leverage getting built up into assets that, I think everyone knew would have a hard time unwinding. So yeah, I think that hopefully the money market sector and the DeFi kind of vault stablecoin sector in general improves just in terms of transparency, in terms of improved oracles and improvements in how trust assumptions are built around leverage essentially. But anyway, I have to drop, guys. You guys keep on going, but it was great to chat with you. And talk to y'all later.
Well, it's great having you on. Thanks for joining. Maybe, Rob, so Stephen, he wrote a thread on kind of a InfiniFi transparency dashboard. So maybe do you want to walk us through there and maybe give your opinion on what would happen to the overall DeFi landscape if...
That was a rabbit hole, by the way. Finding out what every single underlying asset was actually exposed to and what those underlying assets were exposed to was intense. But to InfiniFi's credit, there was actually zero exposure to Elixir or XUSD. And that was after doing not only the direct exposures, but also all of the indirect exposures. So hat tip to you guys.
Thank you. We were very aggressive on diligence. We have a quite thorough and extensive risk analysis process that we go through before any asset becomes available for allocation from InfiniFi. And just to really, I'll talk to us first, and then I'll also kind of talk about what was the other part of that, Matt?
I think do you think that the overall like yield farming landscape will suffer a sustained hit from this? And it's going to, even though InfiniFi is not exposed to any principal risk as of now, because like you guys are not exposed to any of the ones imploding, do you think that the like yields decreasing will have negative consequences for your TVL and the yields you'll be able to offer through PTs?
So, I mean, I'll talk about our transparency and our security first, then I'll talk about that. So we're very committed to letting people know exactly where the money they deposit into our system goes. And stats.infinify.xyz is the result. Like Steven just did a really good deep dive into it. Long story short, before any asset becomes eligible to even be allocated to by InfiniFi, it has to go through a thorough risk review process. That includes audits, that includes taking it before a risk council, and the risk council is mostly made up of hedge funds. Few well-known people are on it as well for like advice and input. Steven's one of them. And basically at that point, we're sourcing the diligence from these funds, many of who have deposits in InfiniFi. In fact, all of them have exposure to us. So they have directed set of alignment to share their diligence that they've already done and say, yeah, we've done diligence on this, it's good to go. Or no, we have done diligence on this, put it in the back of the line. Or yes, we did diligence, do not touch that. And a single no is all that it takes to disqualify an asset from allocation. We actually did review Stream at one point, and there were 2 or 3 no's, and that was very easy. It's like, okay, yeah, this is we're definitely not allocating any capital to this, and we're going to stay away from anything that has exposure. So even with this, we still de-risked yesterday. And you're talking about money leaving the markets. Like we had some exposure to Reservoir, and I don't think Reservoir has any. I think they're perfectly fine. But they were the only actively managed strategy in the entire book. And the prudent thing to do from our perspective was to pull that deposit, trigger the mechanism that we have to pull deposits when we need to, and re-enter that capital later once we've made additional improvements to our monitoring systems and once we feel that the dust has settled. So very, very, very careful. Now, as to how this is going to affect DeFi, I do think that 400 million is probably gone. And I think that for really 2 reasons. One, that $93 million hole, it's not going to get filled. And 2, those loans are not going to get repaid. And because they're not going to get repaid, they're going to get liquidated. Why are they not going to get repaid? Lawyers are involved. Whenever lawyers touch anything, everything stops. People stop moving. Money stops moving, court orders are placed, injunctions are made. The first thing any lawyer is going to tell you is don't do anything else. Don't make it worse. And that is what those people over at Stream are being told right now by Perkins Coie. And they're not going to pay anyone back. They're not going to do anything. Nothing will happen. And it will take years. Maybe months, if it's really, really good months, but probably years. I believe Celsius took 2.5, maybe 3. That was a high-profile case. So those positions are going to be stuck, and they're probably going to be liquidated. And I know I'm sounding like a Debbie Downer here, but yeah, if you have exposure to that, I'm sorry. That's probably going to. You might see 10% of that in 2 or 3 years. It won't be through DeFi. You're going to have to be part of this lawsuit. It's not going to be unwound. Lawyers are involved. Extremely rich people apparently are involved on, like part of the Stream. One of the Stream founders, his dad's some billionaire. So that money's not moving. People are putting up their walls.
Nepotism could do the funniest thing here.
I'll say again.
Nepotism could do the funniest thing here.
It could.
Have you ever heard of a rich guy willingly giving away money for free? I haven't.
Not giving away money for free, but maybe like saving his son's reputation, because the people involved in Stream are apparently doxxed. So yeah, let's see how that goes.
I would be amazed to see somebody willingly.
Yeah, I don't consider it likely.
Several $100 million. That would be.
It would be a hilarious outcome.
PR firms cost a lot less than $100 million. That's what'll happen.
It would be the coolest airdrop ever, though.
It would be incredible, but we don't live in a land of hope and dreams. We live in a land of financial realities and cutthroat mercenaries.
93 million for some people is like the price of a Big Mac, literally, in proportion to their net worth. So somebody could do very fun things.
But this isn't a charity.
On the note of
money to their friends through. This is just a bunch of normal people. Like, I don't know. I have a very dim view of this.
Maybe on the note of the lawyers
recipe.
getting involved, do you think that there was a specific tipping point where like a peaceful unwinding of Stream was not possible anymore? Like, was the starting to lend on-chain funds to off-chain entities, was that the tipping point? Or do you think these strategies before were already beyond any like reasonable risk tolerance and pretty much
This was already
to
way
blow up?
beyond the pale off the rip once they started doing the borrowing against their own asset. That was insane. I mean, it could have still been unwound right up until 1010, I think. I think 1010 is what blew the hole. But the entire thing was insane off the rip, and it never should have been done. This was a catastrophic failure in risk management, and generally speaking, a horrible idea. People on Euler had no idea what they're signing up for, and I feel terrible for them. I do think, and I want to add this because I've just been very dark and gloomy here, and I am generally a positive person, but I do think DeFi actually did work here. And I do think we're going to recover faster than a lot of people think we are. Morpho, this was not fun. You know, this sucked, but at the same time, the system worked. You know, leverage went down, and I mean, hey, I don't love it. We had like about 25 million of drawdown on InfiniFi, which I don't like. But at the same time, people who wanted to get out got out. On Morpho, you know, everyone was running for the exits. That stopped. The markets are showing liquidity again. Money's flowing back into our Tau Vault is, you know, back to being positive. Yields, I mean, yeah, the yield landscape has changed, but the Morpho system worked. I do think yields actually are not going to be as low as you think, by the way. We have identified several interesting things that are going on right now, and I will not share too much because I give away alpha. But very simple, very safe assets.
There was rational liquidity flight and irrational liquidity flight.
Yeah, exactly. And simple, safe assets are actually yielding really high right now because people are just running for the hills. Like, go look at Pendle. There are a lot of good quality PTs, Athena-backed PTs, that are yielding quite higher than they were last week because people are exiting their loops. There is opportunity that is showing. And yields here are actually going to be pretty good if you're in one of the survivors. If you're in stream, I can't help you, but I think people in our Tau Vault are going to be pleasantly surprised. I'll say that.
Well, no, curators and people are going to have to compete on actual fundamentals of strategies and not 20x looping.
You're telling me that actually, you know, maintaining good risk preferences and having superior innovation is actually an edge?
No idea what you're talking about. We just take an asset, we 100x long it on a SEX, and we tokenize that. That's literally what people are going to keep doing.
I will continue my rant, by the way, about oracles. I fully agree with everything that was said earlier. I love fundamental oracles. I think the way we do it is the right way. We look at the actual backing of our assets, right? InfiniFi dynamically calculates how much backing any given position has, like any SIUSD position or LIUSD position. We're calculating NAV every single block that someone interacts with the protocol.
Well, NAV is also fundamentally different than having a hard-coded oracle.
Yes, it is.
NAV can be liquidated. So if your NAV starts to go down, then you can still, like, you know, you can get rightfully liquidated. So I think RLP is a good example. RLP is a typically up-only asset. It's a junior tranche of Resolve. But if there are negative funding days, it has the expected negative return. And so you can loop it up thinking, hey, I'm using an NAV oracle, but there are expected times in which it might actually go down. And you get liquidated by that, not by the market price, which is way more volatile than the actual underlying.
And that's how it should be. It should be based on, you know, what is backing this asset, what is that collateral's value.
Well, I mean, a question though, with Stream specifically, the way they were reporting their NAV was not correct. So even if you were using an NAV oracle, and this kind of brings up the question. So I've always been a huge proponent of NAV oracles and fundamental oracles because they protect the user. Typically, actually more specifically, they protect the looper. They protect the person who's providing the collateral. Yep. They do not protect the lender, nor do they protect the protocol itself. But one point I do want to make here is that, you know, you said DeFi worked. I think DeFi worked even with Morpho, even with Euler, even with the curation model. I know people are really mad about the curation mechanism right now, but Morpho is not on the line for that bad debt. Euler is not on the line for that bad debt. The creation model effectively says, look, you are taking exposure to these markets because the curators spun them up. You're trusting these curators. You're trusting the markets themselves. And if anything bad happens, it's siloed exposure. So it's not a contagion to the rest of the protocol. It's not as if now people who are looping USD AI on Euler or on Morpho have any impact from that. So I think even though I am one of the victims of this particular happenstance, I think it worked. I think it worked pretty well.
I tend to agree with you. It was an unfortunate failure in the risk underwriting of both the curators and those depositing to the curators, but no offense to you, Stephen. It definitely it did its job.
One point I do want to add on the argument you said, Stephen, around curation. As far as I'm concerned, you can't have it both ways. You can either go take a curator that has all strategies on chain, everything is verifiable, and you see what infra they use, or you go to a permissioned fund that is licensed, you become an accredited investor, and that's when you give assets to that fund and they manage it on your behalf with fiduciary obligation. Stream was trying to do it kind of both ways. You either go on having permissionless access and being able to withdraw at all times or understanding what the curator's strategy is, or you go on the permission side and you take on the risk that you give it to a regulated entity. It's very hard to do in between. Stream did it in between. Stephen, you mentioned at one point, and I looked and it is true, Stream overall initially when they started, they were all on chain, and then slowly they started to have more of their TVL off chain. And
yeah, the only sort of off chain stuff they had was Wildcat, which we were complaining that was too opaque.
Yeah,
and then 2 months later, half of their NAV was off chain.
Exactly, and
that should have been a sign. But
that's the problem. Yeah. The only reason why we never got into them, and we looked at them for a strategy composition we were studying. The only reason was that it was an EOA. It was an EOA, and it's trusting law. I know him. I met him. I don't think he's a bad person. I don't think he intended for this to happen, but I think it's literally Icarus flew too close to the sun. Leverage was great. I met him in Singapore. He came at an event we co-hosted. We chatted. He was very bullish on getting a higher valuation for Stream, and I didn't understand that. But I think it's just hubris, to be honest. Like, we're all looking for very deep explanations here. I think they just got high on the leverage, on growing TVL at all cost. And at the smallest sign of trouble, it blew up.
Maybe just to look at the opportunity landscape right now really quick, on Pendle, since we mentioned there are some PTs out there with pretty juicy yields. Which of these would you personally stay away from, and where do you think there is some money on the table to be grabbed right now? Of course, like the both of the CT ones, they can't really be minted anymore. We have a few that are very close to expiry, so we have to take that into account. But of the ones you're seeing here, which have like pretty attractive fixed yields, which ones would you personally not touch with a 10-foot pole, and where do you think there's opportunity?
YieldFi was using similar strategies to Stream, all on chain to their credit, but I would not touch them. I know for a fact that Gauntlet pulled their allocation to YieldFi after 1010, and I assume that there was a reason for that.
So YieldFi was also doing delta neutral stuff, like on.
They were doing they were doing the looping of their own asset. VYUSD is the junior tranche that supplies capital to loop YUSD, and it was a similar rehypothecation situation with 2 tokens instead of 1. There's a lot more baggage there that I won't get too in the weeds on. I do not want to, be accused of casting too many aspersions. But there's a long history of that team, and it does involve a few. Well, yeah, I will not get too in the weeds on this. You can go do the research yourself. I really like REUSDE. That's RE.XYZ. Great team, fantastic guys. They have a certain amount of redeemability now on that asset. So definitely do your diligence on it. I know that there's only so much available for redemptions. Your capital is just underwriting reinsurance. They actually have some of their treasury in InfiniFi. So
yeah, I was going to ask about that. If they're doing reinsurance, this is one of those situations where there are some trust assumptions unless there's some auditing done to show that the off-chain investments are doing what they're intended to do.
Yeah, it's a Bermuda vehicle, so you absolutely should do your diligence on it. But I know for a fact that they have a lot of legal framework around that. I've been chatting with their team for nearly 2 years now.
What do you guys think about the Midas and the Silo Greenhouse ones?
This was going to be my only contribution in this part. Not financial advice, but at Tau, our thesis is that the whole rehypothecation and tokenizing rehypothecation meta is going to take a hit. So we are limiting our exposure to Midas stuff. So mHyper, mMev, mFarm, all the stuff like that.
And it should be noted that, like, even though it's probably prudent to reduce exposure to anything that's even tangentially related to the contagion, a lot of the stuff, as Rob pointed out earlier, is there's rational withdrawal and rational fleeing, and then there's irrational fleeing, or it could be rationalized, but it's not necessarily impacted. So like Midas is a platform that hosts a number of different effectively on-chain funds. Some of those are run by MEV, some RE7, some Edge. Some of those curators were directly exposed to stream contagion, but the underlying assets of their vaults weren't. And so you kind of have to make this bet. Well, is it smart or is it prudent to be holding this asset now, given that the curator now is in a bit of a pickle, right, legally? And also there are other Midas assets that are completely unexposed to the contagion, but because Midas is hosting these other assets, they feels related. And so the easy thing to do, the monkey brain, is just, okay, let me just get all of my Midas exposure away, and then I don't have to worry about it. The harder thing to do, but may actually give you some additional edge or benefit, is to do your diligence on every single one of those and see if there are any of them that now have a better APR because people have been withdrawing. The PTs, right? If people are exiting these PTs either because of crazy high interest rates or just because now they don't want to have any exposure to this thing, if they sell those PTs, remember what that means is IY goes up. If IY goes up, that means you can lock in a better risk-free rate. Well, risk-free rate, you can lock in a better fixed rate, I think is a better way of putting it, on the PT, if you've done your diligence and you can assess that that's actually a better thing to jump into. I won't speak for the Midas vaults we're seeing, nor MEV or RE7. But there are other things like, Almanac that I think are pretty exciting. But go ahead, Rob. You look like you wanted to say something.
Yeah, I'll throw a few of the ones out there that I like. Almanac, definitely. We're holding off on allocating to it from InfiniFi while we, figure out how we're going to be actively monitoring anything that has a component of active strategy.
You guys like all the Athena stuff.
Oh, that's where I was going here. I like Almanac personally. I think Almanac looks quite safe.
Right.
But yeah, TUSDE has room now. TUSDE, because people have had to close their loops, there's room in that PT. It's yielding 12.3, quite nice. SRUSD Strata, they just launched their full market. Previously it was PUSDE, but now it's actually got additional smart contracts, so do your diligence. That's yielding around 9.6, and that's the senior tranche. So good asset, very good asset in my opinion. CAP, CUSD, STCUSD. A lot of people don't understand how CAP works. And
it's all over collateralized. It's either over collateralized loans or Aave loans.
Yeah. Well, here's the thing: is if you give CAP money, you are not the one on the hook. The guys on what is it? It's the restaking platform, Symbiotic.
Oh my gosh, Eigenlayer, yeah. Eigenlayer and Synthetics.
Symbiotic. They're the ones on the hook. And they are the ones who are going to get liquidated if any of those borrowers, who are people like Concrete and Hyperrhythm and RE7, fail to repay the loans. So those are the guys who are taking all of the risk for 2-3% yield, which I don't think that's a great deal personally. I wouldn't do it. But if you're lending to CAP with dollars, you're not on the hook for any of that. And those guys on Symbiotic, they're underwriting you. So if anything happens to Hyperrhythm or any of those guys, you get paid out from their money. So both those PTs are about 12 and 13. Obviously, InfiniFi, we're yielding about 12.5 and 11.5 on both of our PTs. So definitely recommend checking that out. A few of our people had to close their loops because the rates spiked. So mean, obviously Athena, the Athena stuff as it is it's decent. SUSDE, USDE. I personally have knowledge that makes me think that the YTs on those are extremely underpriced.
Which ones?
USDE and SUSDE. They're being priced right now at 6 and like 6.5. Based on things that I've heard, that is undervalued. And I would be, I cannot say more than that.
So perhaps the people doing napkin math on InfiniFi season 5, season 6, or whatever season it is, might be underestimating the amount of InfiniFi tokens being given out, right?
Literally go read the article that Athena put out about season 4 retro. And there's a line at the bottom that says, basically, something to the effect of, I believe it's 8%, it might even be 10%. People have never made less than that, is what they say there. They comment on how that's never really happened. I am just quoting the Athena article.
I mean, of course, you're taking somewhat of a directional bet there, because we've seen the InfiniFi TVL collapse down from, I think, 15 billion before October 10th down to 9 billion now. And the InfiniFi token, INA, correspondingly has not done very well. And if the ETH, BTC, and whatever funding rates are staying as low as they are right now, obviously there is going to be a point where InfiniFi is not willing to emit further tokens as incentives just to push up a certain yield. But yeah, I think if you believe in the project overall, and I think InfiniFi, amongst all the DeFi projects that has been that spun up over the past 2 years, I think they've delivered an incredible growth story. And yeah, personally, quite a big INA holder.
Yeah, I definitely am a big fan, obviously, of InfiniFi. So if you're looking for good PTs, or heck, even YTs, I know Steven has some thoughts on this, but the Pendle markets there are doing quite well.
Yeah. I mean, I totally agree. One thing that's also kind of slept on is the Pendle LP markets. A lot of people don't provide liquidity. I think those have been pretty interesting. And of course, if you hold, but some people I know are actually doing a delta neutral on Pendle, so they'll have a bunch of Pendle, lock a bunch of Pendle, and then short a bunch of Pendle, and the shorts have been paying with positive funding. It's high risk because if you've locked your Pendle, hedging can be super dangerous, and you have to manage that pretty aggressively. But then you get boosted APRs on your LPs, and sometimes you can hit 25 to 30%. Mileage may vary. Don't just go ape into that. But the benefit of that is that you're getting these really competitive APRs, plus you're also getting points. So you get to participate in all of these really good yields and the speculative aspect of future airdrops.
Arguably right now there is a bunch of opportunity to pick up some YTs or to take like stronger directional bet on certain DeFi protocols, because everybody is trying to panic out. But
well, if people are selling
undoubtedly
PTs, it's the opposite. If people are selling YTs, then yes.
Yeah, but I think the implied valuations of many DeFi protocols that are yet to launch their tokens have significantly decreased over the past week. Like the FTV or market caps at launch, I think many people expect that to decrease. So if you think that the overall market cycle in crypto is not over, you can probably make some bold bets here, which might pay out very nicely.
I tend to agree. I also would comment, though, that I don't. Okay. I think if you're talking about, random, just kind of short-sighted projects, that's valid. If it's a money grab, if it's a cash grab, if it's like people who very clearly weren't building long-term. At the same time, I would also point to Aura as a great Aura and Velodrome as two really good counterexamples of bear market launches. Aura, I believe, was June of 22. Launched right after the Terra Luna.
Do you mean Aura as in the balancer layer?
Yeah, I do. They had a fantastic launch, and that was probably the deepest depths of that bear market. Velodrome, another great example. Also, I think launched that summer. came out smelling like roses. I mean, now Aerodrome has a partnership with Coinbase.
There's one thing on Pendle I want to say that I would hate myself if I didn't. I cannot believe we're the only ones that do this still. We are very bullish on fixed rates, and we're very bullish on fixed rates acting as an insurance mechanism against volatility, especially against like black swan events. We have a bonds product where we put the PTs that we like most. Me, 0x Roger, and a couple of our own colleagues from Tau, we actively manage it, and we add assets, we remove them. The core thesis is that if you are long DeFi, you just want to always have some capital on hand, we've built this to always be a place for like longer term treasuries. Getting fixed rates, and especially having those rates locked in when the market goes bad, is a blessing, and it's great to have that stability. Now, the only caveat here, and we are working on an article that will explain it in depth, is needing to understand how implied APY works for Pendle PTs, and especially how it works in the case of a share that contains multiple of these. When you enter, when you exit, will drastically affect your APY. But overall, we built this for like longer term, like at least 2-3 months of actually staying in the position. We also still take no performance fees on it, so please let me work for you for free in that point.
All right,
Steven, you got to leave in too. Go ahead. Closing thoughts.
Closing thought. Oh, you.
I mean, for you.
I also have to leave.
I showed my stuff. It's safe. It's open. There's a prospectus open for it.
It is also cool that we have like the two teams that are effectively doing Pendle ETFs both in the same call right now. So
that's how we met. I don't know if you know.
I mean, like,
InfiniFi reached out to us because we
together.
Launched this. That's how we met. That's how we started talking.
Yeah,
there's different angles on a Pendle ETF. We hold to maturity because we do not like mark-to-market operations. It is too complicated.
Yeah, and the ability to choose whenever you want to exit on InfiniFi is super clutch. So two different products, both doing something very cool. I will say, like to wrap up my thoughts on the whole insanity, I think we're going to see some curators fall out of this, and then some other curators maybe come out of this as champions and use it as a marketing gimmick. I know like CBB was singing his own praises, and he deserves his victory lap. So I think people who deserve the victory lap should have it. Maybe we see a restructuring of who gets the most capital and TVL in terms of moving forward. I think risk teams are going to become popular and in vogue again. So like, your Chaos Labs, your Gauntlet, I think they're going to start doing a lot more. Hopefully they do more stuff. Exponential should really take a stab at like becoming a big player in this space in terms of risk analysis. And so, yeah, that's where my head is at. What about you, Rob? I know you got to jump too.
I have a lot of thoughts. I think personally, this is very much validation of what we've been doing with InfiniFi. We have taken a very slow and steady, lower risk, higher returns, but still not the highest returns that we possibly could have done approach. We've avoided these really, fly-by-night operations, and this, to me, feels like validation of that. So I personally am excited to continue scaling that approach, to keep moving forward, to start playing with, a few new types of assets that are also quite safe. I'm excited for RWAs. I think this washout here is really just going to be not great. It's going to suck for the next few weeks, but at the end of the day, it's a great wake-up call for the space that we need to be paying a lot more attention to the amount of risk that we as users are taking on when we engage with the protocol. I think it's going to lead to a lot more transparency and a lot more of a focus on transparency. And yeah, I'm here for it.
Do you have a specific outlook how this is going to develop going forward? Do you think there's going to be like a sort of DeFi vault association of different entities who are trying to agree on like a objective risk metric and like third-party risk managers, or like do you think there's going to be a similar structure to as in TradFi funds of funds, there's going to be a vault of vaults spinning up and like doing the risk management? Because I think one of the issues we've seen so far is that there have been so many vaults spinning up. Even if you are a DeFi power user, you cannot keep track of all the underlying strategies that all of them are doing, and it is hard to like be constantly in the loop if these are just like executing their proprietary strategies, what they are changing, if they might start to act as a vault of vault into other vaults, which I think many of them have been doing, and via that are stacking up these indirect exposures and exposure to strategies that were not in their initial objective when they were spinning up. So yeah, how do you think that is going to go forward?
I think it's going to diminish. I think just as a general rule, teams that have been doing that are going to see bigger unwinds than teams that have not been doing that. I do think that a formalization is going to be on the near horizon. I have a friend, Alex from Keyring, and we're anticipating doing something with them fairly soon on some lending markets. We'll see how that shakes out. But he's been working on, he and I have been discussing this. InfiniFi technically conforms to certain components of Basel III in the amount of reserves that we hold, not in the custody component. That Basel III goes out the window when you're talking about DeFi. But the concept is good. The concept of having a set of standards that we as an industry agree on. Hey, these are the standards, and then measuring our conformance to those standards on a simple binary. Are they conforming? Are they not conforming? To me, I think that's something that we should be really looking to embrace here. Exponential, I mean, Stephen mentioned them. They're doing good risk ratings. I think that's going to become more pronounced, but I really love the idea of some kind of internal measuring stick that we can all measure against. And I think that is probably on the near horizon.
I do have to jump, Max, but just 3 letters for me as the closing thoughts. KYC, know your curator. Look into who manages your capital.
Curate your curator before your curator curates you.
Exactly. So please do, if you have any funds with us now or in the future, please do curate me, grill me. I'm always down to chat anywhere, at any time. Thank you very much for having me on, Max. Always a pleasure, Rob.
Likewise, Max. Great chatting. Always good to talk to you,
Thanks a lot
Vlad.
for joining, guys. I think it was an amazing
Thanks for
episode.
hosting.
And see you guys around.
Catch y'all later. Bye.
Have a good one.